Somewhere in the last 5 years, the Australian barbecue changed its mind. It used to be property. Everything was property. But if you spend any time now in Australian investing forums, the new consensus is about shares, and it goes like this. Don't bother with the ASX. It's 4 banks and a mining company. Buy global. Buy the world. Australia is a dog. Here's the uncomfortable part. Over the last 10 years, that advice has been right. Not marginally right. Emphatically right. I spent this week verifying exactly how right because I wanted the real numbers rather than the ones people repeat. And the gap is wider than I expected. But buried in the same data is something almost nobody making this argument mentions. And it doesn't soften the conclusion. It reverses it. Let me give you the number first, because it deserves to land before anything else. Over the 10 years to May this year, Australian shares returned 9.07% a year. Global shares, developed markets outside Australia in Australian dollars, dividends reinvested, returned 13.25%. That's a gap of 4.18 percentage points every year for a decade. $10,000 into Australian shares became $23,826. The same $10,000 into global shares became $34,704. You ended with nearly $11,000 more from the identical starting amount over the identical period. And most of us don't invest in lump sums. So let me do it the way you probably actually invest. $500 a month, every month, for 10 years. $60,000 of your own money going in. Australian shares. $95,897. Global shares. $119,744. A difference of $23,848. That gap, on its own, is roughly 40% of everything you contributed. You didn't work harder. You didn't save more. You just ticked a different box. So the forums are right, and this video could end here. Except when I went looking for why that gap existed, the 2 explanations everybody gives turned out to be mostly wrong. The first explanation you'll hear is the Australian dollar. The story goes that global shares only look good because our currency weakened and you got a translation bonus that flattered the returns. It's a reasonable theory. It's also easy to test because you can buy the same global index with the currency hedged out. The exchange rate effect stripped away entirely. Unhedged global shares, 13.25% a year. Hedged global shares, 12.71% a year. The currency contributed 0.54 percentage points. Out of a 4.18 point gap, that is 13%. Take the exchange rate out completely, pretend the Australian dollar never moved, and global shares still beat Australian shares by 3.64 percentage points a year. The currency wasn't the story. It was a rounding error wearing a costume. The second explanation is the good one. This is the genuinely strong argument for holding Australian shares, and it's the argument I most wanted to be true. Franking credits. When an Australian company pays you a dividend out of profits it has already paid tax on, you get a credit for that tax. A foreign company can't give you that. It's a real, structural, legislated advantage that only exists here. So how much is it actually worth? Australian shares are currently yielding about 3.52% in cash dividends. And over the last 4 years, those dividends have been roughly 83% franked. Run that through the company tax rate, and the franking credit is worth about 1.26 percentage points a year in additional pre-tax income. But what it's worth to you depends entirely on your tax rate, because the credit gets added to your income and then offsets your tax. If you're in pension phase, paying no tax, you get the whole thing. Franking adds the full 1.26 points. Your gap shrinks from 4.18 to 2.92. If you're an average earner on the 32% marginal rate, including Medicare, franking is worth 0.85 points. Your gap shrinks to 3.33. And if you're on the top marginal rate, it's worth 0.67 points. And your gap is 3.51. Sit with that. Franking credits are the strongest argument for Australian shares that exists. In the single most favourable tax situation available in this country, they closed 30% of the gap. At the top marginal rate, 16%. Global shares won by a wide margin at every tax rate in every scenario for everybody. So both objections fail. The gap is real, it isn't currency, and franking doesn't rescue it. Which is exactly where every video on this topic stops. Roll credits, buy the world, ignore your own country. Here's what I found when I stopped looking at 10 years. Over the last 20 years, Australian shares returned 8.0% a year. Global shares returned 5.4%. Over the last 30 years, Australian shares returned 9.3% a year. Global shares returned 8.3%. Read those again. Over 20 years, Australia won by 2.6 points a year. Over 30 years, Australia won. The 10-year window, the one being used to prove the ASX is structurally broken, is the only one of the three where global wins. Nothing about Australia became a bad investment. What happened is that we are living through one long stretch of global outperformance, and the people describing it as a permanent feature of the world are describing a decade and calling it a law. That's the actual insight, and it's uncomfortable in both directions. It means the ASX pessimists are extrapolating from a sample of one. It also means I can't stand here and tell you the last 10 years will reverse, because that would be the same mistake pointed backwards. The gap wasn't random though. It came from what these two indexes are actually made of. The Australian market is extraordinarily concentrated. The largest 10 companies are 48% of the entire index. One mining company is 11% on its own. One bank is another 10%. 5 financials and 2 miners, 7 companies, make up 40% of the whole Australian share market. The global index holds over 1,200 companies, and its largest 10 are 29%. That concentration means Australian returns are decided by a handful of banks and a handful of miners. And the last decade was not their decade. It was the decade of global technology, which the Australian market barely has. The financial year that just ended shows it perfectly. Australian shares returned 6.11% for the year. Underneath that, materials rose more than 47%, essentially carrying the index by itself, while healthcare fell over 37%, and technology fell over 37%. The index hit a record in February and finished the year almost 5% below it. That's not a broken market. That's a market where two sectors decide the outcome, and you're along for whichever ride they take. Now let me turn the same lens on global shares, because it would be dishonest not to. That global index is 73.7% United States. Nearly a third of it is a single sector, information technology. Its top 10 holdings are almost entirely large American technology companies. So when I say the Australian market is dangerously concentrated in banks and miners, I have to say the global index is concentrated too, just in something that has been working. Concentration only feels like diversification while it's winning. The last decade rewarded global concentration and punished Australian concentration. I have no idea which way the next decade points, and neither does anyone showing you a 10-year chart. I should also be clear about what I'm comparing. Every figure here is a total return on an index, before tax, before brokerage, and assuming you reinvested everything and never sold. Real investors sell things. Real investors pay tax. Franking rates move year to year. They were 91% franked this financial year and 65% 2 years ago. And the capital gains rules changed in this year's budget, which affects what you keep when you eventually sell, in ways this comparison doesn't attempt to model. None of this is advice. I'm one person showing you verified numbers, and your situation is not mine. Here's what I think the honest version of this looks like. You don't have to pick a winner. That's the false choice the entire argument is built on. An investor who held 30% Australian and 70% global for the last decade earned 12.0% a year. $10,000 became $31,047. They captured most of the global decade, kept their franking credits, kept exposure to the market where they earn and spend and retire, and never had to be right about which country would win. Someone who went 50-50 earned 11.16%. $10,000 became $28,806. That's a rough blend rather than a real portfolio, so treat it as direction rather than a promise. But the point holds. You gave up some of the last decade's upside and bought insurance against the next one. And that's the trade. Not maximum return. Survivable return in a world where you can't see forward. 3 things, and only the first one is urgent. First, before any of this matters, cash. If losing your job would force you to sell shares, the allocation question isn't the question yet. Emergency fund first, always. Second, find out what you actually own. Most Australians hold far more Australian shares than they realise because their superannuation fund has a home bias built into its default option, and their share portfolio has one too. Add both together. The real number surprises people. Third, and this is the one I'd push hardest, decide your split once, write down why, and then leave it alone. The cost of home bias over the last decade was real, but the cost of chasing whichever region won the last 10 years over and over is worse, and it compounds against you every time. The ASX had a bad decade. That's a fact, and it cost home-biased investors real money. It also had a good 20 years and a good 30. Anyone certain about which of those the next decade resembles is telling you about their confidence, not about the future. Diversify because you can't know. That's the whole reason it works.